Hi, my name is Alan Stocker, Certified Financial Planner Professional and Managing Partner here at Patriot Asset Advisors. And over the past couple of videos, we've done a series on annuities and should they be part of your retirement plan. So this topic we're going to touch base on is the fixed indexed annuity. So several years ago, these contracts were called equity indexed annuities, but due to a couple of reasons, they've changed the name. So what I'd like to cover is how these differ from fixed indexed annuities, the important terms that are associated with the contract, and touch on a couple of articles that have been written that we will link to the video that address this particular topic, and also what are some of the fees associated with the contract. Okay, so fixed indexed annuities are a subset of the fixed contract. They're kind of a hybrid, if you will, between a fixed annuity and also a variable annuity contract. So to start with, these are extremely complex investments. Most people have a very hard time grasping the whole the whole way that they earn money with these particular contracts. So you want to do a lot of homework prior to putting any money into any of these particular investments. So much so that there was a publication back in 2019 where FINRA, which is the Financial Industry Regulatory Authority, put out an investor bulletin where they mentioned how complex this particular investment is and warned against folks just blindly going into these contracts without really understanding the terms and conditions for them. So these particular contracts are often, at least in a broad sense, pitched as giving you the opportunity to have market participation without downside risk. So in the back of your head, you're probably asking what could go wrong with that. Well, there's a lot of different ways that the insurance company goes about making the calculations for your market participation, if you will. So some of the important terms that you'll want to be highly aware of prior to looking at these contracts is participation rate. You'll want to know interest rate caps. You'll want to understand the spread, if there is one affiliated with the contract. You'll want to know about bonuses and riders and how those impact the contract, and also what the calculation is for point-to-point annuity compensation. So back in 2012, FINRA, the Financial Industry Regulatory Authority, published a piece called the Equity Indexed Annuity, a Complex Choice. Now, I didn't realize this says equity, and I've been calling them fixed contracts. FINRA issued a note to the insurance companies several years back requesting that they make a change to the fixed name within the piece as to not confuse investors with these being equity contracts, and also the fact that they are not, FINRA doesn't regulate the insurance carriers with these contracts, so these are not actually security products in that particular vein. They caution investors in a couple of different places here that you can see in this particular article. But one is the fact that the rules can be changed with regard to the calculation for your return. So it states that the insurance company may change on an annual basis the participation rate, the cap rate, and or the spread. And these can be detrimental to the returns that you receive. So I kind of equate this to Lucy and the football back in the old Charlie Brown days of where Lucy moves the football. You have these contracts that may last for 7, 8, 10, 15 years even, and you've got your money tied up in this contract, but the rules of the game can change. It's almost like changing the rules of a football game or baseball game midstream. So again, you want to be highly cognizant of what you own prior to making an investment in these particular types of contracts. Also, Fidelity had a piece back in 2019, I believe it was in October, and in their article, it was called Indexed Annuities, Look Before You Leap. And I'm quoting here, in reality, indexed annuity returns are typically comparable to conservative investment products, not the stock market, not the stock market indexes or stock mutual funds, end quote. So what I read in there is their returns are more correlated with CDs and money markets than anything to do with the stock market. So uh, further quoting, investors often mistakenly think they are investing in the market directly with an indexed annuity, and actually they are surprised when they find out that their investment returns aren't actually measuring up. So one of the areas where fixed index contracts also kind of have a problem in my mind is they're often sold as not having any fees associated with them. That may be true that in any publication you don't see any fees associated with it or any costs, but the opportunity cost is really where there's an issue with these particular contracts. Fidelity writes, indexed annuities typically do not have any upfront sales charges, but there are often significant surrender charges, fees you pay if you need access to your money before the surrender period ends, and other hidden costs. While indexed annuities are often sold as no-fee products, investors still incur costs to own these products by giving up higher returns in exchange for guarantees, explains Tony Gordon. In addition, surrender charges or surrender fees for the top 10 selling annuities average 9% in the first year, which obviously is rather high. Also, indexed annuities have significant opportunity costs that are passed on to consumers by the insurance company by limiting potential returns through a participation rate, cap rate, or a spread, noted Gannon. That's why it is important to ask your agent explicitly to define how the product works so that you'll know upfront any factors that could put a drag on your potential return. So it's my opinion that indexed annuities are among the highest commission products in the investment business. Having been in this business for over 30 years, returns on fixed indexed annuities are reduced by paying higher compensation to the reps to market the product. So again, look before you leap. If you have any questions, again, we are pretty good at reading annuity contracts and statements and so forth, and we'd be happy to help you with any annuities that you own. Again, Alan Stocker, Patriot Asset Advisors. Thank you for your time.